Hello everybody, this is Ehab. Today we're going to talk about some of the questions that beginner investors face on pretty much on a daily basis. When should I invest? What do I invest in? What are some of the things that I should be aware of? The tax consequences, all of these things. I'm trying to simplify things and put it in perspective since investing is so important for your financial future. It shouldn't be that complicated, so I'm going to try to simplify it and just do this video about investing tips for beginners, and let's dive into it. So tip number one is start now. So there are no right time in the market. We're trying to see when the market is going to cool down or when is the next crash or anything like that. You're not waiting for any of that. Start right now. Whatever money you have on the side to invest, money that you don't need in the next 2 or 3 or 5 years, just go ahead and invest it. The longer you wait, the more the market is appreciating in value, the more it's going to be more expensive for you to invest into the market. So don't wait for the right time. It's always better to not trying to time the market because no one can time the market, but try to just go in the right time and just try to invest whenever you have the actual funds to go ahead and invest in it. Now, the second tip seems to be pretty obvious. Invest into something or buy stocks that you actually understand. And what I mean by that is I've seen a lot of people that chase, random biotech companies or some kind of, oil manufacturing companies or something like that. I wouldn't recommend it, especially for beginners, because we don't really understand how these companies are valued. You'll really have to go deep dive into the intrinsic value, how you're going to try to see if the fair market value of the actual stock is actually worth the price that they're offering. It's a lot of work. So try to avoid that. Try to buy stocks. If you're buying individual stocks to begin with, try to buy stocks that are easily understandable. Stuff that we see around us, companies that you understand and know what they're doing for a living. Per se, those companies tend to succeed. So if you look around, for example, if everybody's holding an Apple iPhone or something, you'll know that Apple is a pretty solid company. If you're driving around houses and you see boxes of Amazon being delivered pretty much every minute, you know Amazon is a good company to invest in. If you're trying to search for something and you use Google, for example, you know your search engine is pretty much Google across the globe. That's another solid company to invest in. So don't chase companies that you don't really understand. Try to invest into something that are pretty broad. You see the companies, they're pretty successful. You know what it's for, what they're doing. Then you can go ahead and invest into these stocks. Now, tip number 3 is try to diversify. So don't buy a single stock and just keep all your money in one individual stock. Always try to diversify. So for example, if you purchased an Apple stock or if you purchased like a Tesla stock or anything like that, try not to keep it in the same category as a technology company or a car maker company or whatever it is. Try to diversify into different sectors. That way you're mitigating the risk of if some company goes down in value or something happens to the company, you're not losing all your money. You still have some of it that is performing a little bit better. And that way each one will pull off the other. If one goes down, the other one goes up. That way you're a little bit more diversified. You're not going to lose all your money. And again, you're not going to be making millions of dollars if everything goes right. But at the same time, you're not going to lose all your money if the market goes down or something happens to a specific company. Now, tip number 4 is don't let the media scare you. And I have seen this over and over, and it's been talked about for a long time that people get fearful when the market goes down and they start to panic and they sell everything. And I have seen it with my own clients. I have seen it with my own friends and relatives where they actually have some kind of investment and it's been performing pretty well over the past few years. But for some reason, the minute the market goes down, they think, okay, this is the end of the world. They watch the news for a couple hours and say, okay, the market is going to crash. We're all going to die. And that's pretty much it. And they try to sell everything in their portfolio. That is a horrible way to go about investing. If you don't control your emotions when things happen like that, because the market is going to go up and down. Over time, regardless how good of an economy we have, the market is going to go up and down. We're going to have some kind of correction. We're going to have some kind of a recession. That's okay. That's part of a healthy economy, that it has to go up and it has to go down. But you have to control your emotions and not let the media or whatever you're reading or listening to scare you to the point that you're selling at the wrong time. The minute you sell these stocks or investments, whatever, at the wrong time, you lost a lot of the investment and the probable upside that's going to happen after the market recovers. So you always don't want the media to scare you, but at the same time, control your emotions regardless what happens. Invest the money, forget about it, and then move on with your life. Try to not even watch that much news at that time. If something bad is happening, try to listen a little bit, but don't really pay that much attention to it, because that's only going to affect you negatively if you know you're going to react based on whatever news you're listening to. Now, tip number 5 is focus on your saving percentages. So you can't really control how your performance is going to do with your stocks or investments or whatever it is. You can't really tell if it's going to make 10% a year or 12% or whatever the case might be. You can only control how much you are contributing to your own investment. So try to always keep in mind that the more you're going to have money, the increase in salary or the side business or whatever the case might be, try to increase your percentage of investment as well. Don't think about it, you're going to make this much a year or you're going to make 10% or 12% return on your investment, then you're good to go. Always try to increase your percentage of contribution or savings instead of trying to control how much you're going to be getting in return at the end of the year. So tip number 6 is set a goal, like an investment goal, and work on that goal to work onto your advantage on how much time you're going to need to reach that specific goal. For example, if you're thinking about retiring at a specific age, you're going to have to calculate how much you're going to have to put as an investment per year or per month or whatever to reach that specific goal. As long as you have a goal in mind that you're going to retire by a certain age, or you're going to have that much investment by a certain age, or you want to reach that investment by a certain time, just set that goal so you can work towards it. Otherwise, if you don't have anything to work towards, most likely you're not going to be motivated to contribute or even increase your contribution to your investment or to your savings. Now, investment tip number 7, I would also say whenever you want to invest, try to invest over time. Don't just do a lump sum of everything and dump it into the market at a specific time. I don't think that's a good strategy. It's always good to dollar average it, which is basically means try to contribute over time for a long period of time. That way you're getting the best of both cost and the ups and downs in the market. So if the market goes up, you are buying a little bit at that time, but if the market goes down, you're also buying a little bit at that time. So if you divide up the two, most likely you're getting a dollar average, a good return on your investment. So always try to buy over time and set a schedule or an auto deduction or auto investment from your bank account to the investment that you have and let it go. That way, every month or every week, to me personally, I think the shorter the period of time, the better. So like every week or sometimes even every day, you can put an investment. As little as it is, whatever it is, the money that you have, just make it go individually every single week or every single month. That way you're dollar averaging your investment, and over time, that dollar average is going to work in your advantage because you're buying at the good price that you should be buying into. Now, tip number 8 is keep your cost as low as possible. This is very critical. I've seen it also with so many of my clients that go and purchase into different investments, different brokerage firms, different apps, and they don't keep track of their cost. They just think, okay, I'm going to invest $1,000 here and there and whatever it is, and I'm going to watch my investment grow. But in the back end, they don't see that the more they're trading or buying or selling into these specific brokerages or even apps, they're charging them at the back end, $10, $12, $15 a transaction. And also a percentage on the actual investment over time. They have to charge you some kind of management fee. It depends on your investment, but sometimes they charge you a management fee percentage of your investment or even a return. At that time, you're losing a lot of money. If you don't keep track of your cost and try to mitigate it and see, okay, this is the lowest cost I can get, then you're losing a lot of even your gains. So when you think your return is 12% on your investment, most likely after your cost, you're looking at 9%, 8%. It depends on how much they're charging you. So always keep in mind that you have to lower your cost as much as you can, so you're keeping most of your gains and most of your principal to begin with. Now, tip number 9 is automate as much as you can. Automate the process. Don't let it be manual, a headache type of thing that you have to, like a chore that you have to do every single week or every single month. You're probably going to lose interest after a while. This is a human nature. We all do. You're going to get bored of it. You're not going to get motivated. You're going to keep watching it every single week or every single month because you're contributing manually into it. If you don't see it growing as fast, you're probably going to lose interest as well. So try to automate the process as much as you can. Keep it on auto deduction. If it's through your employer, then just do an auto deduction from your payroll. That's even better. If you're doing it yourself on the side, then just go ahead and automate that as well. Just go ahead and have it set up where it directly pulls from your bank account and puts it in the investment, and that way you set it and forget it. Now, tip number 10, and this is the most important tip of all, in my opinion, you have to keep taxes in mind. Every time you make a transaction, whether you're purchasing or selling or even holding, think about the tax consequences. It's going to cost you a lot of money if you're thinking about doing day trading, or especially if you're not professional, and I'm talking about beginners here. If you're doing day trading, you're gonna be spending a lot of money on taxes, and this is not a good strategy, because every time you sell a stock on gain, you're gonna pay taxes on that, regardless if you keep it in your brokerage account or if you don't take the money out, or even if you roll it into another stock. This is never a good idea. So always think about taxes. The longer period, the better. You're going to be treated as a long-term capital gain. Leave it. Just if the stock or the investment goes up in value, even better. Just leave it as such, and over time it's going to keep appreciating in value. And don't cash into it unless you really have to. But if you keep buying and selling stocks, or even in any type of mutual fund or an index fund, you're going to pay taxes on that. Regardless if you take it out again or if you don't, you're going to pay taxes on it. So always think about taxes when it comes to these things. That was it for today, guys. I hope that was helpful. These are just investing tips for beginners, and I hope that anybody that thinking about investing or thinking about making the right move to actually invest into their future, this should help them a little bit, at least in my opinion.